boys. Uncle Jerome, baby. Uncle Jerome. All right. What's happening, G's? Welcome back. It's 1:45 a.m. The press conference starts in around 45 minutes. It's gonna be an interesting moment for all of us, for you, for me, for the whole community, for LTA, for the whole world. All right, this is a moment. We have been waiting for the Fomc for a long period of time, and I think it's time to get the party started. What do you guys think? Hope you guys are doing well here. Smash up the like button, hit the notification bell if you're new. This is the last week. Let's let's make sure that we cover the Fomc with you guys live. We're gonna listen to my uncle today. Exciting times. It's gonna be a good one. It's gonna be a good one. All right. Good luck. Yes, sir. Okay. Thank you so much, Uncle Jerome. As always, with his fucking money printer. It's unbelievable. We're going to talk about the Fomc today, guys. We have a lot of things to cover in regards to the dollars, especially. Of course, this is all related to the dollar, but not just related to the dollar. This is related to practically the whole world. We'll see the whole economy responding towards their decision, okay? And I'm going to tell you up front already right now at the moment that this is going to be nasty. Nasty for a lot of individuals here in the chat, because I know what kind of DJs we have in the chat right here. Of course, we have also a couple of more responsible guys in the building, taking it a little bit more easy. But I get it. It's full margin for some of the OGs here in the building. All right, I can see you. Let's see what we have with us today. First of all, right now, let's kick it off strong. And let's get the party started, man. We have so many things to cover. Get the music a little bit down here. There we go. Beautiful. Super late today, guys. Super late today. Well, not maybe for every one of you guys here. For some of you guys, probably in the afternoon. For us, it's almost 2 a.m. here. Looking forward to it. I'm telling you guys, the later it gets, the more energy, the more excited I get about the day and everything that's coming. All right, beautiful. Ronit, my friend, good to see you. And Sako, good to see you too. Mike, the crypto noob. Layla says, I got another 100k challenge today. I'm on it next. Yes, nice. Dominic, Lord Leonin, Karim, Max, Official Gaming, Panto, Maxona Entertainment, Maria Gonzalez, Francesco, the G. Fantastic stuff. All right, so today, guys, is a very important day in regards to the dollar. All right, the dollar is coming down, or has been coming down for the past 90 days straight. We have been seeing the dollar trending down here for the last 90 days right now. If you calculate the top to the bottom where we are right now. All right, 84 days of bearishness for the dollar. All right, in anticipation towards what we covered today here, the FOMC press conference, the interest rate cut. All right, The question is not if, the question is how much we are going to cut rates today. All right, that's what we are thinking about, what we're looking at for. You can currently see that the 4.75 to 5 now has a 60% rating. So they're actually thinking of a 50 basis point rate cut rather than a 25 basis point rate cut as well here. There are reasons for that. The reason why this could happen, indeed, a 50% hawkish cut might be happening as somewhat of a jumbo start, right? A jumbo start in order to just make sure that from that moment onward, we can just, narrow it down and slowly but surely scale down when it comes down to these interest rates right here, okay? So in essence, generally speaking, when you think about a 50 basis point rate cut here, that should in essence weaken the dollar, generally speaking. However, there is a but, there is a plot twist here that we have to take in consideration. The plot twist is as follows, all right? That is, if the underlying economic conditions are not looking that fantastic, then there is actually a bigger chance of a potential recession. And that, you guys know what happens when there is a recession. The yield tend to go up, and so does the dollar as well here. And the other question is, what happens with the dollar now being already, priced in? Is there somewhat of an indication that in the last 90 days, we have already been selling off the dollar here in anticipation of a potential rate cut right now? And now that the day has finally come, is this then the moment for price to potentially reverse? All right, we have been seeing this also happening very, very often, where big events tend to always do the opposite of what the majority things can actually happen. And we have been talking about the fundamentals already on the dollar. I created a video about the dollar, about the potential scenarios of the dollar flipping bullish from like a more fundamental perspective, right? The large speculators are buying in the retail is at an all-time low in terms of bearishness. I recently checked it, and we're so bearish. We are as bearish when it comes down to the net positioning of retail traders. We are as bearish as we were in 2009. All right, 2009 was the last time we were showing this significance in a negative net position for retail traders when it comes down to the CT data. That is bearish for retail, very bearish for retail. When you think about that here, they have to understand that that's not that good. Why? You probably know why, all right? Retail is usually on the wrong side here. However, short-term volatility is no exception for the rule, okay? So we don't know what will happen in the short term, and everyone that tells me right now, I'm sure it's gonna go up or I'm sure it's gonna go down, we're gonna get some Mr. Hindsights in the chat later on, ladies and gentlemen, because we're gonna get people saying, you see, I told you so. But trust me, it's gonna be very tough to determine exactly what the direction is going to be in the very short term, okay? In the long term, after the news, during his speech, we might pick up and we might get a feeling, a sentiment feeling from Uncle Jerome, what his future predictions are. And these future predictions are potentially more important than the short-term reaction that we're going to expect right now based upon this cut potentially already. So in around 8 minutes from now, we're going to see if it's going to be 50, it's going to be 25 basis points. I highly doubt that there will be none rate cut here. I really limit this as absolutely minimal. So we could say it's going to be 25 or it's going to be 50. All right. $25 could be more on the bullish side. I do believe for sure that when it comes down to 25 basis points, this has to be priced in based upon what we have been seeing over the last 90 days. Is it going to be 50? We really have to wait and see here how price is going to react here, okay? So based upon that right now, you can see that gold right now currently is sitting in a really narrow range. We have been building up this range this whole week, okay? This whole week, no direction here. Yes, we came down after we broke below that 72 level, and we came down as low as 25.60 later on. But overall, we recovered. We came back to the Sunday open. We held below the Sunday open. We're still in resistance here, yet we're building liquidity to the upside. It is a mystery right now in the short term what will happen here. All right. I'm not going to tell you right now. Usually we do trade the Fomc here. Usually we do trade the CPI. But in the short term up front right now, I don't think it is going to be a very wise decision from my side. We made significant amount of money on our futures account. We are already in a swing trade position for the dollar against Japanese yen. Also from a fundamental standpoint, it was worth the risk to see that if the dollar starts flipping bullish, that you can potentially turn this into a monster trade. And if you're in a monster trade for the dollar against the yen here, after we have been dropping for so long already significantly, now finally tapping into that monthly resistance, or I could better say that monthly support, okay? We have now been tapping into that monthly support here and we flipped the weekly candle bullish. That's a scenario where I would say, okay, it's worth the risk for me when it comes down to taking a swing trade up front. But of course, this trade is already secured. This trade is already on break even, as well as, our P&L of today here. We secured our profits. Usually I was like, I should stay in. No, I secured my profits here. I'm going to sit out the FOMC for now in the short term. We're going to listen to Uncle Jerome. If a good opportunity presents itself, we will see a good opportunity coming based upon the reaction of the dollar, gold, US 10-year yield, and the Nasdaq, the stock market as well here. Okay, so we're going to listen to Uncle Jerome in around 30 minutes. Any questions, feel free to answer me or ask me anything in regards to the market, anything that you are interested in about. We can take our time here, but most importantly, let's pay very close attention towards the next 5 minutes, because we might see some serious volatility coming into play right here when it comes down to the dollar, and also of course to gold and the Nasdaq and the S&P and the US 30 and everything around this. All right, we will find this out in around 5 minutes. Now, do take in consideration that the first move might not be the move that you are expecting it to be. So if you think that we're going to go up or we go down, that doesn't necessarily mean that this is going to be a one-way street today. Okay, it could easily turn around the moment the press conference starts. You guys know it, you have seen it before. We have seen also many times before where price comes up, or let's say it takes out the highs, it starts flipping bearish, and then as long as the press conference is working, we're pushing down, and the moment the press conference is over, we push back exactly to the level where we came from. We have seen this as well right here beforehand when it comes down to that information. So a couple things that I want to talk about real quick before we head into these in the actual news outcome here. So we see what the dollar does, and based upon that, with the dollar, how gold will respond to that. I'm going to put them next to each other so we know exactly what will happen here. But a couple things that are important to take in consideration, okay? When it comes down to the hawkish versus dovish tone from Uncle Jerome here, all right? You always know that Mr. Jerome speaks in a, you could say, scripted format. All right, this guy has been scripting his whole life. His whole life is one big script. All right, he reads the same old storyline over and over, right? Unemployment rate, strong labor market, 2% goal. You will see that coming very, very soon. Now, what's important to mention here is his hawkish cut or dovish cut, like the hawkish tonality or dovish tonality. All right, I'll give you two examples. If he is, and this is important to mention here, if he is very worried still about inflation or indicates potentially fewer future rate cuts in the next coming months. So for example, the next one should be in November. All right, if he is going to be very limited in his tonality, if we are actually going to cut rates also in November, then that could lead to a complex reaction where initial moves might be reversed. So where we actually start reversing the other way. All right, that means potentially the dollar indeed going into more of a bullish, potentially showing us a bullish reversal. If you see a dovish cut, potentially, and there is more or less concerns about the economic growth, right? The underlying economic data that's showing that but the US economy is underperforming, then I do believe that the dollar will definitely start moving up here. So sorry, hawkish cut, dollar down, dovish cut, dollar up. So it's very important to mention to listen to what he says. Listen to truly what he says about the underlying economy. The underlying economy is what I want to know. I want to listen to him and I want to hear exactly what he thinks is important for the American economy over the next couple months here. Specifically, number one, focus on November. What is the plan for November? And then most importantly as well, what do you think about the underlying current economic conditions? These are the questions that are going to come up. You're going to listen to it and you will see exactly what will what will happen from there. All right. Good luck, G's. Good luck with your trading if you're going to trade up front here. Yeah, I wish you all the best. I wish you all the best. We're going to see what the outcome will be in around 1 minute from now. All right. I hope you guys are ready. Don't be nervous. It's all going to be fine. All right. If you sit in your hands, it's going to be fine regardless. This could be a real great example and a good lesson of what might as well can happen here. If this is your first FOMC or your second or your first rate cut, hey man, you're going to have some fun today regardless. All right. I know you like it. I know you like it. There we go. 20 seconds is. Let's get it. Show us the money, baby. Show us the movements. Karim says no trading for me until we get something stable. No forcing trades cause of the news. Yes. All right. I agree with you, my friend. I agree with you. I hope also that I don't get stopped out. Ooh, we're pushing down. We're pushing down at first. At least at first we're pushing down here. Dollar is pushing down. Number one, first reaction. Gold up, ladies and gentlemen. And it is 25 basis points. Sorry, 50 basis points. If I'm correct. What is it? Why does it say 50? 50 basis points. 50? 50 basis points, ladies and gentlemen. There we go. Significant move here for the dollar. Pushing down. That's not good for my trade. That is not going to be good for my position here. That is not going to be good for my dollar yen long position here. Potentially. Was worth a try though. Was worth a try, but we might hold here. We might hold here. Gold is pushing up. Taking out the highs here for now. Alright. For now, gold is pushing further. Going the opposite direction of what a lot of guys here were thinking about. Specifically, you see that gold now is reaching for the highs here, taking out the previous daily high. Initially, in a split of a second, the previous daily high has been taken out right here, right now. I feel like a football commentator today. Incredible stuff. We're seeing a potential reversal. Let's see if the reversal comes here. Dollar, once again, breaking down here. That is not good for, you would say, my position on the dollar yen here. But we're going to find out what the actual reaction will be. Keep in mind, one more time, this is still the first initiative move here. The first initiative move to the downside for the dollar. All right. Very significant. Gold is pulling back after it took out the previous daily highs. All right. Previous daily highs have been taken out here. Gold is pulling back right now to where we came from. So previous daily high has been taken out. Bye-bye, previous daily high. Hey, that rhymes. That rhymes. Fantastic. Okay. This is actually starting to look very interesting. Dollar is starting to recover a little bit here. I'm very curious to this press conference, ladies and gentlemen. I'm actually very curious to see what we can expect here, because it is such of an utmost importance that we understand exactly what his future plans are going to be for November in particular. Okay. Seal News says, I got 3 stop losses triggered in less than a minute. Tino says, I told you guys to buy. I told you to, Tino. I told you to. I told you to. Congratulations, my friend. You were right. Yes, you were right. Holy shit. We're gonna listen to Uncle Jerome here in a second. Let's see what the dollar does here. Where do we close this next 30-minute candle? The moment the press conference starts here. Once again, we tapped into that daily support. We are still holding above daily support for the dollar, so there is nothing really too crazy for now here. Okay, you guys can see that the dollar is initially pushing down here. It is supposed to push down, to be honest. It's supposed to continue to drive down here. If it is indeed going to be these 50 basis points when it comes down to that particular reaction here. Not gonna lie, that is indeed what the biggest, or what supposedly the expectation would be, but you never, ever, ever know what the exact outcome is going to be over time here. The daily candle on the dollar has no top wick. I think that's important to mention. Doesn't mean anything for now yet. Still mention it anyways. All right, daily candle has no top wick on TVC here. Okay, daily is breaking. Yeah, we're going for a second wave push down here. All right, 50 basis points. That has to be very important. Okay, very, very important. Anyways, you don't trade anymore on New York. I think we took 3 trades last week in 4 streams. I think that was the scenario here. So yeah, some people have the memory. I'm not even going to talk about it. Thomas says 2685 people here. Amazing. Fantastic. I think that we are going to very importantly listen to Uncle Jerome here and what he's going to talk about. Again, it's going to be hawkish. It's going to be dovish. His tonality now is actually what absolutely matters. Okay. Absolutely matters when it comes down to the dollar in particular. Let's also quickly check out what the 10-year yield has done here while we have been pushing. We actually are still holding up very strong. All right, so that's an important statement here from the government bonds, the treasuries, 10-year yield. Right now, we have seen that the daily time frame is actually holding up very well. So the yield is doing its absolute best to hold up here. I'm going to also look at the correlation coefficient for gold and the 10-year. I want to see what the difference is in correlation here. Are we negatively correlated? Are we positively correlated? What is happening between gold and this particular asset here, which is the 10-year yield right now? We're pushing down. All right, we're pushing down overall here. We're pushing back up on the 30 minutes. We are starting to push down. So are we on the 1 hour. It's pretty neutral down. Pretty neutral when it comes down to the correlation between the yield and between gold. All right, gold is trying to push up again above the previous daily high, above the 25.86. That has been taken out in a flash. Right now at the moment we are trying to re-break this, and yeah, at this particular moment it seems that we are indeed gonna continue to drive down here. So very interesting to see. My goal with the dollar yen is actually that we hold above, you know, this particular zone, specifically above the 140.5 until the press conference starts here. So in the next 25 minutes. That would kind of be the ideal case scenario when it comes down to the yen here. I'm also interested in what the yen is doing. We'll look at it later on. It's not important for you guys for now here, but yeah, it's gonna be a very interesting conversation today. Brandon says, "What's up, champ? Respect to you for being awake and providing content at 2 a.m. in Bali. Shout out from Cape Town." Thank you, my friend. Brandon, you are a G, my friend. We're gonna go to South Africa at some point. Looking forward to be there and see what we can do. Cape Town is definitely on my radar. All right, on the futures chart right now, we're tapping into 4-hour support. All right, previous highs are getting targeted right now for the futures chart. That means that we're trying to break the all-time highs again for gold at this particular moment. Right here, right now, we can see indeed that gold is trying to re-break the highs here. And the question is, will gold be able to re-break the highs right now when it comes down to futures? Keep in mind, this is the futures chart of gold. This is also very important as, of course, you know, the spot chart reacts heavily to the futures chart as well. So sometimes you're going to see areas of resistance on the futures chart that you do not really see on the spot chart right here. But at this given moment, we can actually confidently say that we are looking at the same resistance here. All right, all-time high territory, or are we holding below it until the press conference starts here? To be really honest with you, the moment the press conference starts, I do believe there is a chance of a slight pullback as well here due to the uncertainty. And a lot of guys that are trading the FOMC or that were in positions from the morning, usually what tend to do is that these guys are starting to take out some of their profits before Mr. Jerome with his little money printer starts speaking. That's what's happening here. Okay. Can you predict this kind of news to know if it will goes up or down? You can. I mean, you could. I mean, if there are critical key levels, we have been doing it before. But when it comes down to the Fomc, there are so many more variables that you have to take in consideration. Then the question is it priced in or not? Is it better than the forecast? What about the initial move? What about the press conference, right? We have different phases when it comes down to the Fomc. So in this case right now, we did just have the Fomc statement. The interest rate decision is out. But in 20 minutes, the press conference actually starts. And that is usually when the magic happens right there. Okay? Usually the press conference is what it's in essence are doing here. So for now, yield is holding up very well. Gold is trying to break the all-time highs here. It is pushing, it is facing resistance, same as on the futures chart. They're pretty aligned now. Pretty aligned with what we are currently seeing. I'm also very impressed with how strong this US dollar against the Japanese yen chart is holding up. Very impressed so far, to be honest, based on what we are currently can see here. I expected a much more aggressive move to the downside. So I have to see what the yen is doing. Give me one moment, guys. I quickly want to check out what the yen is doing right now. The yen is still looking weak. The yen is still looking on the weaker side here. We tapped into that monthly resistance for the Japanese yen basket. All right, monthly resistance there. Weekly is still not looking that great. The daily candle is still not looking that fantastic here. So this is actually all looking fantastic for me personally when it comes down to the yen. So it's up to the dollar to decide if we are gonna hold this this initial level here, this initial support here. But gold is going. Gold is going. And yeah, we're seeing that move happening. All-time highs are broken. New all-time highs are created. We are sitting at 25.91. That is the new all-time high for gold. You are watching history, ladies and gentlemen. History is what we are seeing here. All right. Are we buying? Are we selling? I'm not doing anything, especially not now here. Okay. Like I said before, this is all gambling in my opinion. It's all gambling, having fun, going in for the sake of it. In my opinion, if you are an OG and you know exactly how to trade, because we had some guys in the chat that knew exactly how to trade this news, then go ahead, start trading it for now. We are listening first to Uncle Jerome, see what his tonality is like, and based upon that, we can re-discuss a potential setup when it comes down to gold. Can the move during the conference be bigger in any way? Yes, we have seen that before as well. We have seen also complete reversals during the press conferences as well here. Okay, I do think that is critical. That is critical. That is critical. What do you think of the euro against the US dollar? Well, let's have a look at the euro as well here. The yen is looking weaker. I like that a lot here. Gold is still pushing down. I mean, we can go to a couple pairs here right now at the moment while we're waiting for Mr. Jerome to see what my guy is doing. We are still tapping into a daily zone, all right? Daily supply here. We have been talking about this zone already for a while. Right now, we're pulling back into it. This is actually very interesting. This is actually very interesting. To be really honest with you guys, if we start to break the lows here, if we actually break the lows here, you will have a fantastic setup, to be really honest with you, okay? What I mean with that is you break the highs here, you tap into the daily resistance, you break the lows, you pull back and you sell off. That's the best scenario, the best case scenario for a setup for the Eur Usd. I don't know, not sure who actually asked me this question, but based upon the daily time frame here, you can see right now that this is indeed a serious area of supply right there. We've been tapping into it once. We are now tapping into it again. We had some pain points there as well here. If we now flip this candle bearish, so it means practically if you flip the daily candle bearish, there is a big chance of a continuation further to the downside for the euro against the US dollar here. So I must say, I'm actually very impressed with this initial setup where we consolidate practically. I need to see where we start when we started to consolidate here. This whole week, same thing as gold. Euro just looks a bit cleaner where we consolidate right there. We now manipulate the highs. If you now break the lows, hey, listen, that's a potential scenario for a reversal. I mean, it's still not out of the picture, at least for now, as long as we stay above or below, sorry, that daily area of supply here. So yeah, that is definitely interesting to take in consideration when it comes down here. Okay. Yeah, I would love to. I would trade that. I would actually trade that. I would trade that Eur Usd trade. There is no doubt. There is no doubt here. Absolutely no doubt in my mind that is the case. Okay. For our resistance on futures, very hard time here to break. We're trying to break it. We might as well re-break it again and actually start closing above it here. That might be very interesting based upon what we currently can see for gold to breaking out and looking at the particular highs right there. It's very hard to break. Okay, very hard to break when it comes down to that zone here. What do you think, Lorenzo? Is the 50-point rate cut, will that make the dollar go bearish for a longer period, or is it possible to just that it recovers today? So the only thing that I'm interested in today, of course, is to see how the dollar closes on a daily, but most importantly, how do we close this weekly candle specifically on the dollar this particular week? If we can close the weekly candle decent, all right, we still have 2 days left, 3 days left for the weekly candle to close here. Hey, listen, everything is possible. Still, we're still in the short-term picture right now. For now, I would say 50 base points, generally speaking, will be considered bearish for the dollar. That is just the reality. There is not much we can do about it, but it does not necessarily mean that when Mr. Jerome starts speaking, that they might get into a kind of a different, that we might get a different feel, a different sentiment from his tonality, right? His dovish or hawkish tonality. Based upon that, we can see how this will go here, because sometimes a 50 base point rate cut is fantastic, but if there are underlying problems within the economy, then it can actually work against the economy right there. All right, we're gonna find out. We are gonna see how that will go here. For now, dollar is coming down, euro is coming up, gold's coming up. We're trying to break the highs here, and a lot of guys were shorting, a lot of guys entering shorts. I mean, do whatever you want to do here, but keep in mind that we're flipping coins here. So we are waiting. 12 minutes left for the press conference. That is what we are waiting for. 30 minutes left for Uncle Jerome. And we're going to listen to him. And we're going to see what Mr. Jerome has to say. Nabil says, I just signed up using Vantage. Use your leak. Is it an A-book or B-book broker? Are there many possibilities to know? Let me withdraw. Well, they're regulated. It's a regulated broker. All right. Regulated by the Australian authorities. The SEC. All right. It's an Australian broker. Yeah. Cannot tell you if it's A-book or B-book, to be really honest with you, because nobody actually really knows that. All right, nobody knows that. I have no insights here. All right. However, I would not put a lot of money on my Vantage account. I have multiple Vantage accounts. I'm not gonna just sit there and put my money on a Vantage account and just literally let it all vaporize. That's not what I'm planning to do here. That's for sure. Risa says, "What is the FOMC? Can you explain it to a non-USA a non-USA person?" Yeah. So the FOMC is an event here that we can discover right now, right? It has to do with the Federal Reserve. They release a statement on a month-to-month basis here, which is called the FOMC statement right there, all right? And they tell you if there are reasons for a potential increase in their interest rates, or if is there a decrease in interest rates potential scenario this might actually occur, right? We all know that interest rates, you know, we are in a debt, you could say a slave debt market. That means that everything is built around debt, all right? Everything is built around borrowing a lot of money. And you could see it this way, all right? The more money you borrow for a lower interest rate, the more interesting it gets to lend out your money towards that particular country here, all right? The more you get for your buck, the better it's gonna be for the currency, you could say. So the higher the interest rate, usually the better for the currency, due to the fact that you would attract a lot more money, all right? That's why, in that manner, the Japanese yen got absolutely destroyed. The yen had a negative interest rate for a long period of time, while the other currencies are increasing their interest rates. And it means that practically lower rates, all right, means cheap loans, more money injected into the economy. Higher interest rates, you know, usually results into more expensive loans, which not everyone can afford, due to the fact that it becomes harder to make a return on your investment. So if you're on real estate and you have a high interest rate, then it becomes very expensive to buy a house and to rent it out, because your return on the investment is significantly lower, all right? So if you make around a 6 to 8% net return per year on your house, if you rent it out, for example, then, you know, you have to pay fees, and these fees and high interest rates are not going to be that beneficial. Now, this is usually the moment when a lot of guys are deciding to sell their house, sell their position here. And at this particular moment, if we start seeing a decrease again in the interest rates, then usually what will happen is that more money gets injected again into the economy, and it's supposedly good, or can act as a stimulus, all right, a stimulus when it comes down to the economy. So an injection of new liquidity is what the market is driving on at this particular moment here. Okay. Eight minutes, just 8 minutes left. Gold going. Gold is pushing up. How to see your playlist videos, because it's hidden. I don't know which videos you are talking about, my friend. We are going to upload a lot more educational content on my channel, as well as trade setups, swing trade ideas, especially is what I'm interested in sharing as well in my on my channel as well here. Besides the day trading and the scalping and all that stuff right here. Okay. 7 minutes left. Gold is going, dollar is dropping, and I mean, I don't think it's gonna be good for me personally when it comes down to the dollar yet. We might get back to our initial entry, right here. But if we stay above this level until Mr. Jerome starts speaking, we might get saved. We might get saved by the bell here when it comes down to the dollar yen in particular. So gold, absolutely crazy. Big gamble in my opinion here. I don't see any particular reason to trade this for now until the news, or maybe even after the news, or whatever the case may be here, specifically today here. This is very important for to understand the bigger picture, right? And a lot of guys are probably not really interested in the bigger picture. They just want to get in and out and gamble their money away based upon some candlesticks. But sometimes it is important to understand the bigger picture as well here, to kind of get a better understanding, a better bias when it comes down to the actual markets. And based upon that, you know exactly what your risk parameters are going to be and how you can actually start trade better or be better biased in the next coming days, if not weeks ahead of us here. So in the long term, this will benefit significantly. All right, this event that we're going to watch, that we're going to listen to, is going to be crucial for us to understand what will happen here in the medium term. All right, that's more important than the short term here right now, based upon this initial move, which is of course where everyone cares about, at least what everyone cares about specifically. Okay, what does 150k express mean? That means 150k funded account. We're trading futures on the side here. We have another one. I just bought a new account in case. I just wanted to scale up. I want to get into multiple 150k accounts here. So we are trying to potentially get this one done here. If I would take a trade, I'd most likely just use this account. I would love to just start a new account, a new fresh account as well here. Get that funded would be nice. In the meantime, this one right now is sitting at around $6,900. Waiting for this candle to close, and then on the 30-minute time frame, and then I think we have exactly what we want, and that is the dollar speaking, Mr. Jerome speaking, the dollar potentially holding up here. I'm not that impressed so far. I'm not that impressed so far with the dollar at this particular moment. I'm not that impressed yet. Okay, as of what I'm currently can see right now. Okay, there we go. By the way, G's, offer here on Vantage right now as well here. You have a pause your challenge, get one for free, all right? So if you can pause your challenge, you get a second challenge right away for free. I understood at first that it was a buy one, get one for free. That was not the case here. It was a pause your challenge and get one for free after that, right? So you need to pause your challenge first. Wanted to enlighten it as well. I sent everyone an email as well today. For everyone who's on the mailing list as well here, everyone is already updated, but that is the case here. So the plan is today that we are gonna give away at least a challenge today. I was supposed to do this tomorrow, but I'm gonna do this today. I'm gonna do a giveaway today here because of the FOMC, man. Let's also just get that done here, and then you can blow your account on gold today right away. All right, with me. No, I'm joking. I'm joking. Is the dollar on Vantage? When yes, how it's called there. I don't think you can trade the dollar itself on Vantage, but you can trade any dollar related pairs on Vantage. That is definitely the case here. Okay. That's for sure. Yeah. All right, baby. Come on, boy. Let's go. Let's get the party started. Ooh, wait. Let's not listen to that. Let's get him first. We will minimize the screen. We will put up our gold chart. We're gonna put the dollar and gold next to each other. That is what we're gonna do here. We're gonna put the dollar there, and we're gonna put gold there. Dollar tanking, 50 base points. Not good for the dollar. Unfortunate, very unfortunate. So far, we're surviving. We are surviving, and we might survive if we manage to hold on tight until the press conference. And we're gonna find out here. Okay, we're gonna find out. Session breaks done. Previous daily highs taken out. I could say the previous weekly high has been taken out. Okay, we're in all-time high territory. Everything is taken out for gold at the moment. Okay. Akshay says, I think gold will come down. It will be the most interesting for gold to come down. It would not be the first time for gold to reverse during the press conference. The initial move and then a reversal. We have seen it before. We have seen it before. Okay. Mohammed says, I'm in a sell dollar yen. Can I close? Should I close it? Well, I'm in a buy. It's hard to give you advice when you are against me. You know what I mean? So I would say do what your favorable is. But for now, I would say that the dollar is indeed on the weaker side. But, you know, at the same time, you know, the press conference might still cause a turnover, right? A turnaround here when it comes down to the dollar. So now at the moment we are tanking, but yeah, it's the press conference that starts right now, which matters right here, ladies and gentlemen. There we go. There he is. The man, the myth, the legend, the one and only Uncle Jerome.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state.
Yep.
Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a ½ percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2%
that's
over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%.
Yep.
This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course.
Okay.
We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation.
There we go.
At the same time,
This is what I'm talking
reducing
about.
restraint too slowly could unduly weaken economic activity and employment.
Look at gold right away.
In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote
Where
our
the gamblers
maximum
at?
employment and price stability goals.
Where the
If the
gamblers at?
economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations.
There we go. You flipped the script. You
well
flipped
anchored.
the script.
Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country.
There we go.
Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve. Steve Leisman, CNBC. Thank you,
Okay.
Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about it.
So real quick, very important stuff here in regards to Uncle Jerome right now at the moment. This is absolutely the way he starts off. He starts off extremely positive, happy, bullish. Everything is fantastic. 50 basis points. Economy has slowed down. And then you see him along the way in the script. You see him turning. And you see him say, yeah, but we have to be careful. We cannot be too aggressive. We want to make sure we respect the families. We want to make sure that everything is going in a smooth manner. So we're not, we're going to take a really aggressive stance. We're very neutral. Right? So take consideration that he started off very aggressively, happy, everything was good. Gold skyrockets. Now he starts to flip the script. Now the questions come. Now it's time to see, what the underlying, reasons are, if there are actually going to come rate cuts in November and all that stuff. This is what we're trying to figure out. What is going to happen in November?
So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and
How
third?
do we make the, sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So
There we go.
a
Right
couple
away.
things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. Again, I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
Go to Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, and they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, and inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress
There we
on
go. Look at
inflation
that pullback.
and on employment moving to a more sustainable level. So that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is are individual accumulation of individual estimates of what that will be in the base case.
Howard?
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year? Typical.
We're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina?
Hi, Chair Powell. Gina Smilik of the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in a solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick?
That's a solid 6.5.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there, but so I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace.
Pulling back before the hourly closure.
You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
6.8.
Clearly, labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And, but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it?
Crazy cool.
Clearly, payroll job creation has moved down over the last few months, and this bears watching. Meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So that's our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that's something that's getting ready to happen. So we're not waiting for that.
Dollar is back, baby.
There is thinking that
dollar is back.
The time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that.
Dollar is
so
back.
That's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael, Keith.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So. And policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment and it is going to take a significant amount of monetary easing to
Futures as
just
well.
maintain it?
So, you know, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, you know, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, you know, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be, their wage increases rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, you know, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person as measured. It's now below around 1, but that's still a very good number, I would say. You know, quits have come back down to normal levels. I mean, I could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months. And, you know, so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
Okay, there we go. Good question.
You know, more data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. No, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. You know, it's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, you know, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I mean, I think we are, it's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds
Hourly
rate.
closure.
Some think we're heading in that direction again. What's the
Hourly closure coming into play right now, literally around the corner here. We might as well just simply close again above that hourly support for the dollar. Closing below the Sunday open for gold is not a good sign. We said it. It could definitely reverse at the end here. However, you don't have certainties, but it could definitely reverse here. We've seen it so many times. And if this hourly candle closes, once again after the press conference, we might as well get exactly back to where we came from, the 25.67. Would not be surprised if we just pull back to the exact level where we started.
But, you know, honestly, we're going to find out. But, you know, it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. It's, again, we only know it by its works.
And one more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so, you know, this is my fourth presidential election at the Fed, and, you know, it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve. And we do that, and we make a decision as a group, and then we announce it. And that's always what it is. It's never about anything else. Nothing else is discussed. And I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind, and you know, it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene.
There we go, baby. Reversal, baby.
Chair Powell, I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, you know, the U.S.
7.5.
decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, you know, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, you know, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, you know, around 2% and close to 2% for some time. But we're certainly not doing, we're not
10 minutes left.
saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is?
We might flip it.
So
We might
housing
flip it.
inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels. But they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this. But, the direction of travel is clear, and as long as market rents remain, relatively low inflation, over time that will show up. Just the time it's taking now, several years rather than just 1 or 2 cycles of annual lease renewals. So that's, I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
So the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Hi, Victoria Guido with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags, and I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think, I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision.
He did it again, ladies and gentlemen.
We might well have. I think that's not,
Uncle Jerome, he did it again.
which is let's look, when at this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? We knew, it's clear that we clearly, literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the paths forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth. Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time. As you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant. But at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
$100 to somebody in the audience right now in the chat if we close exactly at where we opened when this press conference is done. Like we said before, it happens all the time. All the time. He did it again.
Coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
Let me
He looks like that serial killer, remember? This guy, right there.
Give you the second question. So the answer to your question is that, yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
And is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
Right. And then yesterday, there were merger reform finalizations from the other bank regulators. What does the Fed have to do to align itself on merger?
You know, I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage, so very hot labor market, and we had inflation way above target. So, you know, that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today was, I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
That doesn't mean anything.
Vulnerable to a shock now
Neutral.
that could tip it into recession.
I don't think so. I don't, as I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No, thank you.
Thank you.
There we go, ladies and gentlemen. Fantastic. The man himself. You witnessed something incredible today, as always. Uncle Jerome putting in the work for us. Billions of dollars, geez. Billions of dollars of volume. And the same price, the same gold price at the end of this whole event. We're back at where we came from. Welcome to the FOMC. Congratulations. We're going to do a giveaway in a second here. We're going to give away access to a Funded Next challenge as promised. Funded Next now offers a pass one, get one for free. So if you pass a challenge, you get another one right away after that on top of it. If you pass your challenge, you get another one for free. That's always nice. That's fantastic. One funded account and then another challenge right away to start scaling up here. So we're going to give away then actually two if you pass it. If you pass it, okay? Now let's do a little reflection here. As always, if you look here at the beginning of the stream, we said it is not unusual for price to pivot, okay? However, when it comes down to trading the FOMC, and I can tell it over and over again, and I can tell you honestly from my personal perspective, how many times will I be right and how many times will I be wrong, okay? I might get it right once, I might get it right twice, shorting it from the top. But my question is always, when it comes down to, approaching the market from like a professional standpoint, my question is, how many times will I succeed guessing that top, guessing that high, if I will do this 100 times in a row? And most likely, I will not have an edge there. I will not gain that edge in the market. So, in the short term, maybe. If you don't really care about the long term, fine. The short term, I get it. In the long term, I do believe that having an edge is absolutely critical when it comes down to taking the market and treat it like a business and not like a playing field, right? When we want to have some fun here. We're done with that shit. We're done with that shit. Okay, very important stuff. We came down lower than the initial open, all right? The FOMC open, the interest rate decision. We started to push up aggressively. And like we said yesterday here, 200 pips up and 400 pips down, baby. Let's go for gold tier. This is absolutely important because this actually might bring us to lower levels now, all right? A lower continuation here for gold tier. Not looking that particularly strong. So one more time, if you have that consolidation and that manipulation, we do have that expansion, that reversal or short-term pullback could lead into that continuation towards the 2500. Why the 2500? That is the monthly open of September specifically. Okay, this is where we have opened the month and we talked about it. We said 90% of the time for gold in September, we had a bearish closure, all right? A bearish closure. So I never include only the opening price, I also include the closure as well here. I think this is just as important, okay? So if you here look at September over the last 10 years, 91% of the time, we are closing bearish. The best month was in the best year was in 2016, was a 0.54% upwards move for gold. Hallelujah. That was the best month for gold in 2016. That's almost practically 10 years ago right now already. Time flies. All right. So overall, I would not be surprised based upon what we can see here if we get back towards the monthly open during the next coming days ahead of us here. So that's something that I take very, very serious. And I do believe that when we pull back, that we might find indeed from there, finally, some normal setups, some setups that we can trust on and some setups that we can actually rely on based on what we have been looking for. Now, when it comes down to the dollar, I'm actually very proud on the dollar. I'm actually very proud on my big boy right there because we are still in that US dollar Japanese yen long position. We survived the crash and it seems like we are potentially gonna flip this bullish candle based upon the weakness of not just the gold chart now, but also the Japanese yen. The Japanese yen is starting to slow down. So a swing trade is definitely something that I'm very, very interested in right now at the moment. The dollar is looking good from a daily standpoint as well. We might as well flip here, would not be surprised. And you might ask yourself the question, why is it? Well, we gave you these scenarios. One was for the dollar when it comes down to 50 basis points. That is all fun and games, but when it comes down to his tonality, this is where we learn from the meaning behind what he's saying. And he's saying, listen, like we're here to stimulate the economy, yet we're keeping it neutral. We're playing the defensive ball game. And the moment he started to turn his script, right, going from up to down, ending in the middle, we call that the straight line persuasion. Who remembers that from Jordan Belfort? The straight line persuasion. It's like you want to keep people on a straight line. So when you go up too far, people get too excited. When you go down too low, people get too negative, too depressed, right? So you want to make sure that people stay on that straight line. That's what is happening here. He started up in a high, he came down to a low, and now he ended up perfectly fine, neutral base tree. So everyone right now in the chat feels neutral. We're all feeling neutral. We have no idea what he actually means. If it comes down to our outcome now, you're not going to tell me this is what's going to happen, because what I feel, it could be anything. It could literally be anything. Okay? That's the situation, and that's exactly how these guys are doing it, and that's how they do it. They have script writers, A-list Hollywood movies we're talking about here, right? These script writers are absolutely legendary. Okay, what are we gonna do now? We're gonna first of all probably give away $100 because we said that if price would come back towards the opening price after the closure of the press conference, then we're gonna give away $100. I think we're gonna do this while we're also gonna give away the Funded Next challenge right now. Once again, what I believe is important, that this, next 30-minute candle close is below here, that we might as well stay below this particular range. We utilize this big range here. We want to make sure that this range stays below. And based upon that, we want to make sure that the dollar as well holds above here. And the most important thing in regards to the dollar, we close in 30 minutes, all right? The dollar closes here in 30 minutes right now. When it comes down to the future chart, I have to confirm when do we close it. I think we still have a couple hours left. But it's important. That 4-hour candle close for the dollar is very, very important. 40 minutes left. All right, for the dollar to close here. So practically the hourly close here, 4-hour candle closure. This is important stuff for the dollar. Gold is on the weaker side. I would be very surprised if it would come back up again, all the way to new highs right now. At the moment, I think that they literally did everything they could to swipe the highs and come back down, close neutral, then start creating new price structure on the lower time frame, which then can still take a couple of hours from now for it to give you a very clear indication of what the next move is going to be. That's what I think is going to happen here. But overall, based upon that swipe of the highs, the dollar holding above here very well. I'm very impressed so far based upon his tonality. I'm also very impressed. I think this is kind of neutral outcome here, not as hawkish, as positive for the economy as I thought it would be when I first saw the 50 basis points being announced. So based upon that here, monthly open is my target for gold here. That's what I'm personally looking forward to. Why? Because based upon the weekly structure here, that will make a lot of sense. It will bring us back to the 2500 around, which is also that huge psychological level. And at the same time, this is the retest of that breakout that we have seen last week, Thursday. All right, the retest of that breakout, coming back to the opening price of the month, which is 2504. Okay, so I'm going to set up the giveaway right now. It is 3:30 a.m. here in Bali, live for you. I wanted to cover with you today in a special episode today, the press conference. I hope you at least learned something from it on how to not trade the Fomc and how to listen and observe to, the economy here. Sometimes, if you want to evolve, it's something important to stay out, observe, and listen to what Uncle Jerome has to tell you, because it's your wise uncle that sometimes gives you that, unclely advice. You should not take that for granted. Okay, let's set up the giveaway here. Let's make it happen. Let's put in 100 G's. I cannot just put 100 G's there. It doesn't work. Okay, LTA, baby. Type in LTA, number one for the $100 right there. Cash in your crypto wallet. Your boy trades crypto, so you can only send your crypto. Okay, I'm that guy. All right, crypto only. You need to have a wallet, otherwise it's not going to work out. Okay. The next one, Fund Next challenge. Looking forward to do it here. You need to sign up with this link here in the description. Number one, you have to sign up with this link because you will have to buy through this link with this code right here, get BOGO. You have to sign up on Fund Next. If you are new to prop trading, I don't recommend you to directly start with your challenge. If you win, what I recommend is start with a free trial, and then based upon that here, we can, you can actually start practicing first, number one, all right? Before you start the real challenge, okay? Type it in only once, all right? I'm gonna put the anti-spam filter on right now. Type it in only one time. Otherwise, you'll get kicked out of this giveaway here. One time is more than enough. We don't need spammers. We just need to get this giveaway sorted, as we're going to do this on a weekly basis. Every Thursday is usually the giveaway day, but today is the Fomc. So, I'm also going to leave soon. I'm going to travel. I've been, I've been away. I've been here for a couple of years now. I need to go back to the Netherlands, have some things to do here. A little holiday for myself, guys, after this week of trading, after this whole year of streaming with you guys, right? Hundreds of trades this whole year around We have been building, grinding 4 days a week, building this channel, trading live, sharing some, hopefully some wisdom and hopefully also some positivity, all right? To get some positivity out of your life here, to just enjoy the process of trading a little bit more with a smile, a big fat smile, all right? I'm gonna roll the dice. Let's make it happen. 100 G's for my friend right there. Mr. Adrian. Mr. Adrian, congratulations, my friend. Send me a message in Discord. Open a customer support ticket. My team will get back to you. All right, my team will get back to you. Join our Discord for free. Click on the link in the description. Get to the customer support there. And we'll get you hooked. We get you sorted. All right. Get your Bitcoin wallet ready, or your crypto wallet ready, I could say. Okay. Now the next giveaway is gonna be the Fund It Next challenge. All right. You will get 2 for the price of 1, but conditions applied. Conditions applied. You need to pass it. All right. If you pass the first challenge, you get the second challenge right away. All right. You get the second challenge right away. You need to pass it automatically. You get the second one. If you don't pass it, you don't get a second challenge. All right. However, you don't pay for it. Anyways, it's a free add-on. All right. That's what it is about. All right. If you're completely new to prop trading, open a free trial first. Practice before you start officially. You know, I highly recommend to do so here. Dollar yen looks like a bullish flip. Looking good here. I will upload a video very soon about the dollar against the yen, about the fundamentals behind the decision of this swing trade and the reason why I'm currently in a long position for the dollar against the Japanese yen and why I'm personally looking for it to take further to the upside. Potential swing trade scenario here. We are currently already secured on break even. Okay, let's get and roll the dice one more time here. Let's make it happen. In 3, 2, 1, let's go. Mr. Exile, congratulations. Congratulations, my friend. We're gonna get you sorted, all right? We are gonna get you sorted right there. Let me know if you're here in the chat. Type in something so I know that you're there. Otherwise, we have to give it again to somebody else, okay? To somebody else. To somebody else. Let's give it some time, man. Let's give him a minute. Let's give it a minute. Right there. Okay. You think he left already? Nah, he's here. He's here. I see him. Okay, same for you, my friend. Congratulations. Fantastic. Got your account. We're going to get you hooked up here with our team. Open a customer support ticket and we get you sorted with a Fund It Next challenge as well here. Okay. 2 hours later, price is practically at the same level. We're now trading below the open. We swiped highs. We're reversing down here. Dollar is looking great. Euro. Somebody was asking about the euro against the US dollar here. This is what we were looking at. We said if we start flipping bearish, we might as well look for short opportunities for the euro against the US dollar. This is something that might be interesting for you as well to take in consideration. One more time, tapping into that strong daily resistance supply, if you want to call it that. You can see now on the lower time frames, we have been indeed creating that consolidation here. We expanded, tapped into that range. And if we now break structure, then that retracement is where you should be looking for short entries for Eur USD. Similar to gold, to be honest. Similar to gold, also for the Eur USD. Starting to look very, very nice based on what we can see here. Gold is pushing down very nicely. I do believe we're going to be hovering around here for a while. We need to see a strong, nice pullback for it to also look good for us to start looking at normal setups again in the market. The aftermath of the FOMC might as well be a little bit dry, but I do believe that structure will come back into the market and we start moving a little bit later again here. Okay. Very important. I do believe that price could continue to drop towards the monthly open. That will be my target right here. Any pullback could give you a potential short opportunity right there. My goal today was lead you into the press conference, help you out here. It is almost 4 a.m. for your boy here in Bali. I have to go sparring tomorrow. But I couldn't resist being here with you guys, having some fun, looking at my uncle, listening to what this beautiful guy has to say about the economy. All right. I learned something today, and that is the straight line persuasion by Jordan Belfort. Typical. I enjoyed it though. Hope you guys enjoyed it too here. Tomorrow we go back to normal. All right. Back to the normal live streams, the regular events. Tomorrow is the Thursday, and then we're heading into the final day of the week, where I will bake a little holiday, a little well-deserved holiday for myself, and I'm looking forward to host you right there. All right, keep it up, keep your profits in your pockets. We had a good day today. This is looking beautiful. All right, and I wish you all the best, and I hope to see you tomorrow on the stream at 8 a.m. EST. Back to normal, back to reality. No more Fomc, no more Uncle Jerome on your radar. All right. Take care, G's. Have a fantastic rest of your day. I'm gonna go to bed right away. All right. Have a really good sleep. Thinking about you guys. Ciao.
Let's see how you do under pressure. Oh, yeah, I've been wanting this shit forever. I've been in the field with whatever they throw at me. Brush it off, pick myself up, moving on to the better. Okay, hey, yeah, ain't no errors, baby, it's a new era. I wake up early, feeling rich like I'm Kesha. I get to the paper, boy. Extra, extra. Fuck with me, you know that I got it. Come with me, let's take a trip to the islands. We up on the jet, we'll do more than just fly on it. Stand on that hill, you gon' die on it. Boom, boom. Baby, I'm not one of them, you should try on it. Miss me with all that, I'm on it and next. Fuck this up, I send you back to your ex. But good luck with that, this is big as it gets. Hey, let's see how you do under pressure. Let's see how you do under pressure. Give 'em a me shoot a whole clip. Firepower in this coalition. We just turned the field into a demolition. It was desolate, but I had premonition. I was training for war, every exhibition, every extra mission, every enemy listening. Get off my dick, I got bad intentions. Make it right every wrong, and I'm back with a vengeance. I show you the ropes. Peace in my town, I can show you the coast. Up in the shots if they wanted to smoke. If you know, then you know. Suited up, bitch, my whole team do the same. Don't you forget who created the game. Ready for war, I was born with grenades. The trenches where soldiers are made. Let's see how you do under pressure. Let's see how you do under pressure. Give them a name to remember. Hey, let's see how you do under pressure. Let's see how you do under pressure. A moment can live on forever. Let's see how you do under pressure. Let's see how you do under pressure. Give them a name to remember. Hey, let's see how you do under pressure. Let's see how you do under pressure. A moment can live on forever. My soul got the same on my necklace, bitch.